All right, how's everybody doing today? The stock we're looking at is Covalon. I can't pronounce them. Covalon Technologies. I know what they do though. So it was once this is a little infographic I made on Google Gemini. Really fun if you guys want to give it a try. But it was once a heavily leveraged company dependent on volatile Middle Eastern contracts. It's divested non-core assets to become a lean, high-margin U.S.-focused medical technology distributor. And essentially, what it does is it makes antimicrobial um, bandages for people that have a patented formula that irritates the skin a lot less. So we'll get into it here. Um, so the strategic transformation of 2024 to 2025. Covalon's biggest historical weakness was revenue concentration in Saudi Arabia and Kuwait. These large tender-based contracts led to feast or famine quarters. The current strategy focuses on U.S. hospital systems, which provide recurring, predictable revenue streams with higher long-term valuation multiples. So essentially, for the company is profitable. It is making a profit, even so much so that it was actually able to give a dividend, a special dividend. Um, so like you don't see small to mid cap stocks ever giving a dividend unless they're really confident in their financials. So that's a really good thing to keep an eye on. But for them to get back to the price that they want to be at or to get to where they want to be, they need to prove to the market that they can have steady contracts or steady profitable quarters. And recently, their last quarter, they made more than they have in their last three. So that's kind of where it's talking about how um, the market's feast or famine. They're either doing really well or they're not doing that well at all, but always profitable. Um, so post divestiture focus. So they sold Aquaguard line for 30 million USD to focus exclusively on IV clear and antimicrobial coatings. So those would be the bands I was talking about. New direct sales model. So they're expanding U.S. direct sales force to bypass slow-moving third-party distributors. So they're trying to get into more hospitals to be able to do trial runs, and if they work and people like them, then they buy them and they continue to buy them. So why would a hospital choose Covalon over 3M's Tegaderm? It comes down to active protection. Most competitors use a passive barrier. Covalon's tech provides a 360-degree kill zone around the insertion site. Um, so this is theirs compared to a standard antimicrobial. So the antimicrobial coverage is full surface compared to your standard that only has ring only. Visibility of the site is 100% clear compared to your standard partially opaque. Wear time is up to 7 days to the standard 3 to 5. Skin irritation ultra low to the standard moderate. And if you're sitting in a hospital for 3 weeks or a month or whatever, and like it's your loved one and all this stuff, I mean, you're gonna want them to be comfortable and stuff like that. So this stuff really does matter, and it really does affect the skin and stuff. Um, Financial resilience and value. So revenue growth versus net reduction. Notice the J curve forming as a high margin U.S. revenue displaces lower margin international tenders to path the sustained profitability. The path to sustained profitability shortens. So this is good. I'm not a big chart guy. I'm not going to admit that I am. I'm not very good at these, but um, these are their competitors. So it's currently trading at a significant discount to peers on a price to sales basis, largely due to the microcap status and historical volatility. So all that means is the second that these guys secure some secure quarters and a good contract and stuff, it's not going to take them long to fill this gap. Is it a good investment now? Bull case, clean balance sheet. The sale of Aquaguard wiped out debt and provided significant cash cushion for M&A or organic U.S. expansion. Valuation re-rating. If Covalon proves consistent growth to the U.S. hospital market, its multiple should expand from 1x sales to 3x plus sales. So the bear case, execution risk scaling. A direct sales force in the U.S. is expensive and competitive. Failure here leads to a death by 1,000 cuts. Illiquidity, a microcap entering and exiting a large position can move the price 5-10% in a single day. So fundamental score 7.2 out of 10. I wouldn't really go off that, but it just gives you a good idea of what we're looking at here. I bought about $500 worth today, and it jumped 10% because they just did their earnings. Their earnings were kind of they beat expectations, and they kind of held their own. So I think the market kind of rewarded them with that. Check it out here. Yeah, I got a 12% right off the rip. So I mean, I'm pretty happy with that. Not gonna lie. Um, I'm expecting them to be. I think their real value is somewhere around here, around 383, $4. But I'm looking for 290. Um, and I think once we hit 290, it's not going to take us long to get to where we want to go. Anyway, you guys have a good one. Peace out.